Ever scratched your head wondering why your investments don't always pan out how you hoped? Well, it boils down to one thing: risk. When we hear risk, we think of the unknown, right? Like, what if things don't go as planned? In finance, that's exactly what risk is about, but it's not necessarily a bad guy. Actually, risk is a big deal in investing. It's why stocks might do better than bonds, why emerging markets can be super exciting, and why investing in real estate can really pay off. But risk can be a bit of a wild card. It's why your investments might not always hit the mark, why markets can suddenly crash, and why even the pros are always on their toes. Risk isn't something to freak out about, though. It's more about understanding and handling it. It's like the unpredictable part of an equation, the joker in a deck of cards, the zing in your finance soup. So, risk is basically when what you expect to happen with your money and what actually happens don't match up. It's what keeps everyone in finance on their edge of their seats. Hey, before we dive in, don't forget to show us some love. Hit that like button, smash subscribe, and ring that notification bell so you're the first to know when our next epic video drops. And hey, drop a comment below with your thoughts or ideas for what you want to see next. Let's make this channel awesome together. Now you might wonder, how do we figure out how risky something is? Great question, and this is where it gets kind of cool. People often use things like volatility and value at risk, VAR, to measure risk. They give us numbers to work with, but they're not perfect. For example, volatility sees any change, up or down, as risky, but not all changes are bad, right? And then there's VAR, guessing how much you might lose under normal market conditions. But let's be real, when are markets ever just normal? Even stuff like modern portfolio theory has its flaws. It assumes we're all super rational and that markets always play by the rules. Plus, it forgets about things like taxes or trading costs. Remember, it's all about knowing your own risk style. Higher risk can mean higher returns, but the trick is to find that sweet spot that works just for you. So while these traditional methods are helpful, they don't always give us the full picture when it comes to investment risk. So, talking about those big investment strategies like modern portfolio theory and all, they've got some issues. They think everyone investing is super rational and markets work perfectly. But we know that's not always how it goes, right? These theories also kind of overlook some everyday stuff, like they don't factor in taxes or the costs of trading, which can be a big deal. They're thinking too short-term, you know? I mean, these ideas make the theories simpler, but real life is messier than that. It's not always as cut and dry as the models suggest. And it's super important to figure out your own risk level. More risk might mean possibly higher returns, but it's all about what fits your life and your comfort zone. So, while these traditional ways of looking at investing are helpful, they don't always tell us everything. There's more to the picture when it comes to investment risk, for sure. You know, when it comes to figuring out how risky an investment is, it's not just about sticking to the old school methods. You've really got to think about other stuff like how long you plan to invest, how easy it is to get your money out, and those big risks that impact everyone in the market. So what's the scariest thing about investing? It's that risk of losing your money for good. Think about it like this. Sometimes the market dips, right? But usually it bounces back. The real worry is when your investment drops and never climbs back up. That's what we call a permanent loss, and it's a whole different ballgame. Managing risks in investments is super challenging, right? Because of how unpredictable losses can be. It's like trying to juggle while blindfolded. You know, whenever you invest, it's like there's always a bit of a gamble. Every investment, no matter what it is, comes with some level of risk. So, with investing, there are two main kinds of risks. You've got your big picture risks that shake up the entire market, and then there are those more specific ones that hit just certain companies or sectors. Okay, so there's this thing with investing. You've got those big market-wide risks, like when interest rates change or the economy dips. Those? Yeah, you can't really dodge them. But then there are those specific risks, like what might happen to just one company or a particular sector. The cool part is, you can play it smart with those. How? By spreading your investments around, diversifying. It's like not putting all your eggs in one basket, you know? Picture this. You put all your eggs in just one basket. Then, whoops, that basket takes a tumble. That's it, everything's gone. It's like putting all your money into one investment and then it crashes. Think of it like this. If you've got your investments spread out in different places, it's like having your eggs in several baskets. So, if one basket gets dropped, it's not the end of the world because you've still got eggs safe in the other baskets. Spreading things out means one setback won't wipe you out. So, when it comes to handling risk, that's not tied to one specific thing, like a particular company or industry. That's what really defines managing unspecific risk. It's all about keeping an eye on the broader picture, you know? But, even with all these smart strategies in place, there's still that chance of a permanent loss. Kind of like a reality check, right? It's a reminder that no matter what we do, investing always comes with its own set of risks. That's why it's super crucial to get a grip on risk and how to handle it. It's a big deal in the whole investment game. It's not just about chasing the big wins in investing. It's equally important to keep an eye on what you've already got and make sure it's safe. So, how do we handle these risks, huh? Well, there are actually a bunch of different strategies we can try out. Okay, so one of the smartest moves you can make in investing, it's all about spreading your investments around. That's what asset allocation is. Instead of playing a single tune on one instrument, you create a symphony by playing a variety of instruments. It's like being a chef in a kitchen. You wouldn't just cook with one ingredient. In investing, you mix it up. A little in stocks, some in bonds, maybe explore real estate, and keep a bit of cash. It's like creating a diverse menu for your financial feast. Think of it like this. Instead of putting all your money into one thing, you're spreading it out. That way, if one investment doesn't do so hot, you're not taking a huge hit. It's like not putting all your eggs in one basket. It's a smart move to protect yourself from one bad choice messing everything up. Then there's this other tactic. It's called diversification. Think of diversification like planting different kinds of seeds in your garden. Instead of just growing one type of plant, you've got a variety. That way, if one type doesn't thrive, you've still got others that might do really well. This approach spreads out your risk and can help balance your investment garden if certain crops don't flourish. Think of it like this. When you're investing, it's like mixing up your playlist with different tunes from the same genre. You're spreading your bets within one type of investment. It's like not wearing the same type of shoes for every occasion, even if they're your favorite pair. You need different shoes for different needs, right? Like say you're diving into the stock market, right? You could spread your investments across different areas. Think of putting some money in tech, healthcare, and consumer goods. It's like having different strings to your bow. You're not relying on just one skill or option, Imagine it like this. Say one part of your investment, like a specific sector, isn't doing so hot. The cool thing about spreading your investments around is that the other areas you've put money into could balance things out. It's like spreading your seeds across different fields instead of planting them all in one place, If one basket drops, you've still got the others. These strategies we're talking about, they're really good for handling the risks that are specific to a particular company or industry. The kind of risks that aren't about the whole market, but more about what's happening in one particular place or sector. Also, we can't forget about other kinds of risks like business stuff and how a company is run. Those are super important too. So think of it this way. Business risks are all about the stuff that could mess with a company making money. Like if their product isn't selling or costs are too high. Then there are operational risks, which is when the internal systems go haywire, maybe because of a tech glitch or a process that's not working right. That can also lead to losing money. It's like trying to sail a boat. Business risks are like bad weather, while operational risks are more like having a leak in the boat itself. Hey, just a heads up about dealing with risks. It's not about trying to get rid of them completely. It's more about really getting what they're all about and making smart choices based on that understanding, Hey, so investing, it's like a journey, right? Filled with ups and downs, risks, and rewards. Today, we've been chatting about how the usual ways of measuring risks, like volatility and value at risk, have their limits. And we've also gotten into this big idea of permanent loss, the kind of risk where your investment doesn't bounce back. It's a whole different ballgame. We've also talked about how key it is to really get and manage these risks. Think of them not as enemies, but as a core part of investing. It's all part of the game, really. Keep in mind, going for higher risk stuff can pay off with bigger returns, but it's all about playing it smart. You've got to mix things up in your investment strategy, like spreading out your investments to different places. It's like spreading out your chips on the roulette table rather than betting them all on red, Thanks for hanging out with us and diving into all this investment risk stuff. It's been quite a journey, right?